Hey everybody, this video is an excerpt from the Wednesday, February the 24th commentary where on Euro Dollar I broke down the mitigation process, and it was a really great example to explain what mitigation is, what the process is, and how it creates weak lows and what ultimately causes the draw on liquidity. So I thought this would be a good idea to rip that video out of the commentary and upload it as a separate video just to get a better understanding of what the mitigation process is, what it is likely suggesting when we're seeing it in price action. So I hope that this is useful. So let's jump into the video. The mitigation process, when we're looking at the charts, can be a little bit daunting. It can be seen as more complicated than what it really is. So let's just quickly dive into what it means, what it's suggesting, and we'll go from there. So the definition of mitigation is the action of reducing the severity, seriousness, or painfulness of something. So when we factor in institutions and the mitigation process, what this means is they are reducing the severity or seriousness of the loss or the drawdown that they are in the orders that they're placing. And what does that mean exactly? So when we're looking at something like this, we get a break of structure, we get a large impulsive move to the upside. That break structure, we know from that it creates an order block or a demand zone. And when we're looking at that, this is the basis of what we're trading. We're trading with the understanding that large volume has been entered into the market here, which has pushed price up, causing this break of structure. And this is why we look for price to return back to this area to then look to take price long, as it's understood that when an institution or institutions enter positions, their entire position size is not able to be fulfilled within their first order. And by result of that, price needs to come back in and fill the orders that remain after the initial tap into that zone and then cause price to go higher. Now, the process that happens when order blocks are created more often than not are that institutions not only are taking large amounts of buy orders, but they're also facilitating some sells to act as liquidity for their initial buy orders, because they know that their orders are not all going to come through on their first attempt. There just simply isn't enough liquidity. So in some aspects, they're taking the other end of their liquidity. So when price moves to the upside, rapidly breaking structure, what we'll know and what we'll see is that they're in profit on their longs, but they're in quite a loss on the sell side of things. Now, one thing that needs to be said and understood when it comes to institutions, banks, large funds like that is the fact that the sheer volume and the size of the capital that they employ is quite large. So they're able to hold on to drawdowns and incur losses that are much larger than what we would be able to reasonably anticipate. But also one other thing to take note of is most institutions aren't trading with stop losses because they're trading with such large volumes that their stop losses in many cases would just not be respected. So with that said, their sells, as they continue to push up in price, they're in more and more drawdown, but this is unrealized losses. It's not a realized loss until the position is closed. Therefore, they don't actually have to record that on their statements. They don't have to actually realize that as a true loss. But when it comes to accounting, things like that, they're able to use these unrealized gains and losses to offset income and expenses, which would of course need to be adjusted later on when the positions are closed. But sometimes what you'll see is the process of mitigation where they take that other end, the sell, push price above and take a larger loss, so it looks like their profits are reduced. But with all that said, and going through the technical components of some accounting treatment, things like that, at the end of the day, they're in sells and they're in buys. Their buys are in profits, but their sells are in a loss. So what ends up happening is they know that price is going to eventually seek the liquidity back at their order once all of this supply has been met. So we had a lot of demand that was generated right here and pushed price rapidly away from this price area. And basically what it's doing is trying to seek supply at these various price levels. And when we get that supply, we start to see price coming back down, finding more demand now that all of the supply has been facilitated from this order. But of course, we need to remember and be mindful that there are more orders that are still sitting here from these initial orders, as well as our orders would be sitting in here because we'd be looking to go long on the basis of this order block play. Now, once price actually gets to this order block, two things are going to happen. One, the institutions are going to load up on more buys to push price higher, but they're also going to close their sell positions that they took right here to push price to the upside, which is why we usually see a large displacement in volume and price. And so what they've effectively done is they've loaded up on buys right here, went into profit. Price moved back down. They mitigated out of their sells. So they either closed them for break even, a small profit, depending if they close it lower than their entry, or a small loss. The small losses don't affect them. It doesn't impact them because at the end of the day, their main goal and their main objective was to bring price back here so that they could then load up on more buys and push price higher, which would bring them more profits. Now, with that all said, begin to dig into the mitigation process and what that means. So what that effectively means when we're looking at price action with these crudely drawn arrows is when we start to see price action doing basically this sort of price behavior, what this means is that we're seeing a series of mitigations, and we're seeing, in this case, bullish order flow. So we see price create a run to the upside, an impulse, it breaks structure, it returns back to that original origin point. We mitigate out of the sells that were created here. And in many cases, what you'll see is the same process happening again, more sells and more buys being taken. We break structure, we return back, and the process starts one more time. And this can go on indefinitely. This can continue happening. And basically what this is doing is institutions are moving their money and loading up on more long positions. And what this usually means to a certain degree that all of these lows are protected and that you won't see price trade below them because this is where all of their buy orders are being placed. Now, that being said, at some point for all good trades, we have targets, we have reason for closing our trades to begin with. So once we hit that threshold, maybe we have a higher time frame point of interest that institutions are looking to sell. What do? They flip the script and they target their old mitigation areas as newfound areas of liquidity. And what does that mean exactly? So we know that when price action is being created on a chart, many conventional retail traders look for areas of support, areas of resistance. And the only way that they understand and see this being created is once it's already happened. And when we see this process already happening, we've seen the money being moved. And by the time price gets to this point, all of these transactions are done. The institutions are more than likely not looking at these points as points of interest anymore. They are more concerned at here. So their initial entries were to push price higher, taking their longs and making profit. But once we hit this higher time frame point of interest, this is when the bias switches to short. This is when they execute the short positions and new order flow begins to happen. So once that happens, they know that many retailers are going to look at this as trendline liquidity, support and resistance liquidity. At the end of the day, what does that mean? There are a ton of orders looking to trade this long, short, and everything else. There's a lot of retail traders that are going to be reacting off of this area thinking that it is significant. Now it is significant, it's just not significant for the reasons that they'd be looking to buy those particular setups. And what's more than likely going to happen is you'll have a lot of buys in and around this area, this support zone. Many people will look to take buys, will get stopped out. Now, there will be some people who have sell stops here. The sell side liquidity may win, get tapped in, and be able to take that trade short, which would be great. But what we also know about order blocks is we could see something like this where they get tagged in, they feel good, they got some profit, but then price returns back to the order block, tags in, mitigates the sells, and then continues pushing down. Basically, what this is doing is when we start to see this collection of order flow, this mitigation, this bullish order flow could also be flipped inversely for bearish order flow as well, but we can then begin to see that this is liquidity being stacked. And what you'll notice the more you look at charts and you start to see this phenomenon, and what you'll see eventually is that that is where price is drawn to. Why? Because it's drawn to the liquidity that was built. Who built it? This is manufactured liquidity. This is the mitigation process, and this is the end result of most mitigations. But initially, we use it as clues to show that there's an intent to push the price higher. And that's the two main functions of the mitigation process and the two clues that we can arrive when we're looking at the mitigation process. One is seeing that price is being propped up and that we have strong lows being created initially, and that basically the money is being moved from institutions higher and higher until eventually we hit some sort of catalyst, some sort of point of interest, some type sort of price level that then switches the bias from long to short. And then at that point, once the shorts are initiated, it needs to target areas of liquidity And where is that area of liquidity? It's the manufactured liquidity that was created on this series of mitigations. And that's effectively what the mitigation process is. That's why it's important. That's why it's important to understand it when you're building trade ideas. And then it's also important to use as targets when you're in the opposite end of those trades. So looking for sells to target this liquidity being tapped in. And now we're going to run into an example of this on Euro US dollar, showing the mitigation process leading into an order block, the effectiveness of seeing that process being created, which then gives us the cause for price to go lower. And what this also does, one last point, is when these order blocks are created, we're creating demand zones. There's demand for higher prices. Once price taps into these demand zones, it clears out all of the demand, all of the buy orders that would be resting here. And this is another part of the mitigation process. So once price does move back to the downside, there's no more demand here, which is why you'll often see price just absolutely break through areas of what looks to be strong structure. Why? Because the mitigation process has scooped up or absorbed all of the demand or buying power that happened here, which is also why you see inefficiency being created in the markets when there is no demand to soak up any of the selling orders that are coming into the market. Price is rapidly moving away. There's nothing to stop it, to support price from continuing to drop. So when this happens and there's no demand, we just see price absolutely melt. And more often than not, this will create inefficient price action for price to later come back to and fill up. But initially, this is the process to eliminate all of that demand that's in the market so that price can freely move to the downside without having to worry about being stuck on these pockets of demand zones. So I hope that's helpful. And let's jump into the example on euro dollar. And what we can see if we just look at this bit of price action, that order block that's been tapped into, we see price tap into this order block. If we look at structure, what we can see is price, after taking out these equal highs, created this range in price. We have this swing low and this swing high. We did create these equal highs, which was a little bit troublesome or a little bit worrying when we were looking at price coming back to this area. And this is actually a trade that Phantom took. So he's broken that down in the team trade section. So I'm not going to speak to it too much, but what we can see quite cleanly is that we have this area right here. We have this order block, price tapped into that order block. We've also created some equal highs right here. I'll just mark that in with a rectangle instead, just so it's a little bit cleaner instead of drawing 1,000,001 lines. So what we can see is we do have an order block right there, price tapped into it. This would be more of a confirmation entry because we've broken structure once. We looked at the origin of the move that broke that structure. We can also go down to the 1 minute chart and we can start to see that we have this area right here. We can even look at this candle, but as we can see, price did tap into this area. So it would be more prevalent to look for that. Now, if we're looking at it from that light, we can see that in theory, we did create this pullback, these equal lows. We broke those equal lows. We created this low. So we've created two breaks of structure on the 1 minute chart, broken to the downside. And then we've just basically created all of this trend line liquidity, all of this cause for price to move to the downside, basically creating all these weak lows, things like that. We've tapped into this block and moved back to the downside. And what we could have done is if we were looking for a confirmation entry, we could have placed an order. Stop loss, I would at least have my stop loss above these highs. Even a 5 pip stop loss is not out of the question. And then looking to target either this order block, this initial one that we've tapped into, with a larger target of being either this order block or even the lower one. And that's how I would have framed up this trade. I didn't personally take it, but that's how I was viewing it when I was watching it happen. We had these equal highs. That's what in some ways put me off of the trade. But besides that, the price action was super clean, especially on the 5 minute. We had that range. We broke that range. We had a lot of inefficiency to fill. And then we came back to the order block super correctively. So if you're looking at potentially when to take a risk entry versus a confirmation entry, this is a perfect time to really look for a confirmation entry. When you see price doing this really super corrective price action, go to the 1 minute chart and it just shows it even more cleanly. We have this just basically this series of mitigations. So we tap in, we create a block, taps in, we create a range, it doesn't necessarily tap into, but what we can see is we break from a wick. We have this range, we fill that range. We create this range right here, tap into that. We create this range right here. We break into that. I don't know why I deleted that one. We create basically this range right here, these two order blocks, or these two bearish candles rather. We tap into that. You can see as we break that structure, we create that. This is the series of mitigations that you would look for. This can establish bullish order flow, but since we're on the 1 minute chart, we can use this as clues as it leads up to a higher time frame order block. That order flow is creating a cause for prices to go lower. We can see that we're basically reducing all of the demand that would sit in the way of price being pushed lower. And that's effectively what the mitigation process is on a lower time frame. We're creating areas of demand that basically break any chance for price to be propped to the upside. We're basically eliminating all the demand that would rest here. So as price comes to the downside, there's virtually no orders. There's virtually no orders sitting at these areas. So price is free to just fall. And that's what the mitigation process is, especially on the lower time frame. It's clues on what is happening with price action. When we're seeing basically lows being softened like this, it gives us an inclination that price wants to go lower. And what's happening here is all of the demand that is being created here is being taken away. So all of the buy orders are being consumed. That way, when price moves to the downside, there's virtually nothing in its way to continue moving to the downside. And then generally speaking, what that gives us as well, if we just go back to an hourly chart, this is why imbalance gets created the way it does, because there was nothing standing in its way to just push price down as rapidly as it did. And that's the mitigation process. That's why it's important. That's why it's good to be mindful of it. You don't necessarily have to trade it. I mean, if you wanted to be a superhero and trade all of these long, you could have had a few good trades for sure. Super risky. I wouldn't recommend it, but it's a way you can do it. But basically what it's telling us is that order flow is giving us a cause to push price lower by softening all of the demand that is being built up here, so that there are really no buy orders that rest in this area, so that when price does tap into that order block, when the large order is placed in the market, it just runs. There's nothing stopping it. And as we can see, if I just clear up all this gibberish, we had this last block that was tapped into right here. We have one right here. We had a little bit of a slowdown right there. And then what happened? Price just fell off the cliff. Why? Because there's really nothing else standing here. We had this one that wasn't necessarily filled. We filled in that one instead. So we have a couple areas that we seen price did slow down and, see a little bit of accumulation of potential orders, a little bit of, support, if you will. But otherwise, that's why this price drops so hard, because we see this clean and clear mitigation process occurring. And that's why the risk entries can be so powerful when you mix it with that corrective price action. And that's why corrective price action can be advantageous to us if we can understand the order flow that is behind it.